Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room right here from TicketTacker. Let's just move right into the TicketTacker platform here. Trading the gold market last at 1840, down about 1140. Silver is at 25.11, down about 69.70 cents. Silver is a close about 25.11 on the silver here is going to activate a buy trigger. Close about 25.11 on silver is going to activate a buy trigger. At the close of the bar at 7:15, the trigger would be activated. The gold market is trading below the average of 1844, so the day trade momentum is neutral to bearish. A close above 1844 would negate this bearishness. It has activated the target of 1829 with a bearish trend momentum, or it would negate the signal on a close above 1844. Gold and silver prices on Thursday settled mixed. Gold posted modest losses Thursday on strength in stocks and higher bond yields. Silver prices moved higher as signs of economic strength in China are positive for industrial metals demand. Precious metals also have supported on a report that President-elect Biden will push for a huge pandemic stimulus package. The package that was announced was about $1.9 trillion. And it looks like the market is saying pretty much it's not enough. The gold market is reacting negatively against the stimulus package, which is confirmation that the market is not impressed with that. It demands a lot more stimulus than what appears to be happening here, as some of the economic indicators that came out this morning regarding retail sales indicate that the economy is not picking up at all. they were real on the low end of expectations. The gold market has saved support from political instability in Italy. Members of the ex-Premier Renzi's Italy Alive party quit the cabinet on Wednesday, leaving Prime Minister Conte without a majority in parliament. Unless Conte can secure additional support to regain a majority in parliament, he may be forced to resign, form a new government, or call a snap elections. Continue to see, political instability, obviously, in the Eurozone. Some of the comments on Thursday that the Fed Chair Powell were bullish for precious metals when he said that there is a lot of slack in the labor market that's going to depress inflation, and that the time to raise interest rates is no time soon. So when you take a look at the gold market in terms of the fundamentals, I'm pointing out that sometimes the market doesn't react the way that you think it should. And the expectations prior to this announcement obviously were very bullish for precious metals, very bullish for the stock market. And as it turns out, basically that what we have here is an opposite reaction, counterintuitive reaction to the fundamentals. The market that I'm watching very carefully now is the E-mini S&P, because 3824 was the high that was made recently here, and this market has broken away completely from the reality of Main Street. And I think once the reality sets in, and we're going to begin to see a lot of money come out of this sector, as it is in somewhere in the cloud, separated from the reality of Main Street, the economic reality. And there's no doubt that the economic indicators that came out indicate the pressure is for interest rates to continue to stay low, possibly go negative. The government is desperately trying to ignite some kind of inflation in the economy by providing the stimulus, by creating money out of thin air and providing the stimulus to the economy. The expectations are that as we move back into the economy and people begin to normalize, stabilize their lives, their businesses, their jobs, all the stimulus is going to be extra money, basically. And the expectation is that this money should come into the economy. Let's take a look here for a minute. Just watch the market here and see what's going to happen. What's happening? the stock market has been long overdue for an adjustment and correction. And today looks like we have a bearish day here. So we want to see how the market reacts into these levels that indicate possibly buyers are going to be identified. Now, this area here in blue is an area that is telling us that from a day trading point of view, the price has gotten into an oversold condition. So we don't want to, just sell into the hole, so to speak. And if we miss the move, we miss the move. But you can see here that the market got up to this 38.10 area. And it failed. Yesterday was the first day that it failed up here. And activated a short trigger. From the 7-1 level. And now we've come down to the extreme below that mean just in a matter of days. And you can see here the market reverting from this level until now that it broke here. So it's activated now a weekly short trigger. The daily has gone neutral with a close below 37.76, and it has broken pretty much this harmonic level that now has become resistance, major resistance, 37.66. A close below at 7.15 here is a bearish trigger activating the 37.08 level. This is the first bar. Conservative traders can use this bar simply to identify the alert, the trend, and execute the close of the next bar. On a close below, it is the most conservative entry point. The buy one level in gold today is 1829. The low so far today is 1838.60. I'm sorry, 1830.60. That's pretty close to 1829. So let's. It looks like the metals are in an area of accumulation, and you can see clearly here where the trigger points are. A close about 25.11. Or activating 24.66 on gold. On silver, buy trigger 1829 or a close above 1844 will activate 1860. You can see in the gold market here on the chart on my right, the Fibonacci uptrend line is running up against the 1929 level, which indicates the buy one level of the VCPMI. So the structure, the daily structure, is on the left, and the weekly and the monthly are on the right. It did not follow through from this key reversal signal that was activated yesterday. So we want to see how it does into this range of support, which almost is making a little bit of a wedge in here, as you can see, between the Fibonacci trend lines. So 1843.44 is the breakout point of this descending channel, which is a very bullish sign, and that's a confirmation. The trend momentum is activating 1860, 1875 initially. So as you can see, in between those prices here, we have a slew of other indicators, which are the weekly and the monthly. And we've been trading against the monthly average of 1864 a couple of times, not having the buy-in power to get through that. Because once we get through this level, 1864 to 1880, it's gonna break the market resistance, create a bullish trend momentum, and there's not that much resistance above here all the way to 1932 to 2015. We continue to get an accelerated downtrend momentum here on the stocks, the indices. And the target that's been activated here is 3708. It's in an area of a weekly short trigger, creating a bearish trend momentum, with the daily signals is oversold neutral on the daily. So there are no signals really for trading based upon the rules of the VCPMI. You as a trader, as a self-directed trader, obviously can trade every tick. But the VCPMI provides a very specific criteria, a methodology, and discipline to follow. And trading around the average, or from the average, as the magnet, it simply identifies the trend momentum. And the idea is that we want to see the extreme above or below that average price to be able to trade, make an intelligent trade. What you see here on the silver chart on the left is the market went up to that 2511, met the target from below, did not have enough buyers to get through that, and what we saw was sellers instead come in, as you can see, reflected in the price, bringing it down to the low that we saw here of 2478, which was a higher low than previous. Seems that the equity market is picking up volatility on the downside. 3708 is the target. One of the markets that we're tracking here is the GBTC, and we have seen a pretty major top being made up here with a high of 48.65 yesterday. So this is like bullet holes up here, this chart. The market came almost right up to filling this gap, and now it's resumed the downtrend. So it looks like the market has broken down into a V-shaped top, down almost 10%. And let me take a look here from the low that we made. Let's say from here on October 1. Let me see if I can do some Fibonacci retracements in here for a minute. And see how far we can come down. I'm going to use this low here before the breakout into the high of 48.65, 48.65. It already has accomplished a 23% retracement, Fibonacci retracement at 40.25. It's going, the next target is 34.43, and it could come down to as low as 29.74, which is a 50% Fibonacci retracement. And this is where ideally I would be very much interested in getting back into the market, but it can all come down to all the way down to the 1835, which is a 78.6% retracement from this move, and still it would keep this in a bullish pattern as long as it doesn't break this 1835 level. If we break this 1835 level, we could come down all the way down to even 1478, which is it's a golden ratio target 161.8, pi golden ratio target of 1478. The gold mining shares are obviously getting hit as well here this morning. And we also seem to be entering into what appears to be a major area of buying and demand here for the gold mining shares. So taking a look at the daily gold chart here, we've come down we seem to be building what appears to be a widening uptrend channel here between these Fibonacci trend lines that I'm using. And even though we kind of broke down from the area of distribution of supply of that 1932 to 1950 area, we are coming down into this critical target of 1829. 1829, 1813 are extremely strong levels of support. 1810 is the annual target. Of the 360-day cycle. The monthly buy is 1816. The 360-day cycle below is 1810. So it is my opinion that these levels here are indicating the bottom of the market, pretty much, the bottom of the barrel. And we want to be very careful about shorting the market into this area, as we could see a reversion to unfold almost any time. We have a couple of weeks until the end of this month to complete the seasonal pattern, and we should resume into the first quarter of this year into testing at least the 2000 price level in gold. We are in choppy area, so again, make sure that you don't overtrade, that you don't over leverage yourself. Don't bite more than you can chew, because on these corrections is when the margin calls will affect you. And you don't need to get out if you don't have to. You want to hold on to this position. We have a long way to go to the upside still yet. So you want to be patient with this, because I do believe that the last market to adjust to this economic chaos that seems to be getting worse day by the day, it's just based on these economic indicators. And once again, the fear is that we may go into an implosion, a deflation factor, an implosion of assets. And that's not what the Feds would be to the best interest of anybody for this to occur. So I'm trying to identify where the market is going to complete this seasonal bottom here that we're looking at in order to commit myself up to my objective in this market. There's always a chance, if this market breaks these levels here, the down all the way down to 1798, which is the buy one weekly so far for this week. But I doubt if we're going to see that today or the end of this week, as much as closing the week. Even if we close at this level, so 1830, 1831, we're going to be going in with a bullish sentiment as we come into next week. And I think as we come into next week, these numbers of support are going to be higher. So plus we have a holiday coming up, I think on Monday, In I'm not sure. I think the U.S. markets are closed on Monday, so anything is possible when that happens. Seem to be we catching a little bit of a bid on the E-mini S&P here. This is where the VCPMI is telling us that we are oversold daily. We're in a bearish trend momentum weekly. But if we get back about 37.66, that's going to be pretty bullish for the stocks. It would activate a buy trigger and a bullish trend momentum daily and weekly. The metals are catching a bid. 24.88.50 on silver. 13.32.90 on the gold. $33.60 traded in gold. It's very quiet. Very, very quiet all across the board here. Stocks are down 33 on the E-mini. And we seem to be getting a little bit of buying down here, so that's a good sign. Let's keep watching this market here. It looks like we're beginning to see some buying come in here. Not quite getting a buy signal here. We came down into that 1829 earlier here at 7:30. This is the buy signal activated here from 1829 on the gold. It's long from 1828.70. 32.70 traded, 32.80 bid. Very slow day today here, building a base on the gold here from the buy one level, and the silver not quite coming down to that 24.66 area. So it's a very quiet day. $31.70, 32, $31.70, $31.90 bid. Very quiet market here, just floating for a couple of dollars, but it's floating above the buy one level of 18.29. We've seen a little bit of buying entry and interest in the Dow and the E-mini S&P here. And one of the reasons why basically we're watching this more than anything else here today, except for the gold market, is because I am adhering to trading the highest probability signals, and that's when the market reaches basically the extreme below or above the mean. And right now, we're neutral on the daily and the mini, and we are in a bearish trend momentum with a weekly signal. $31.90 bid. One of the things I'm looking at here is on the daily on the daily charts from the high that we made of 2089. We've come down to this 50% Fibonacci retracement of 1771, which was completed and reverted from there all the way up to what we saw was 1962. And that was into the monthly target, the weekly, and reverted back from there, coming back down to below the weekly average of 1880, below the monthly average of 1874, and have come down to the buy levels of the daily of 1829 and pretty close to the weekly levels are underneath at 1798. 1813 is the buy two level. And so it appears that we seem to be testing an area of support once again.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control.